Hi, good morning, everyone. Thanks for attending. Got a large audience. It's back to school week, and it's great. We have such a large attendance of over 400 online to our webinar focused on multifamily CMHC and conventional lending. At Peak Hill, we love growth and enjoy growing with our clients, and no better way than to provide an update on best practices, updated CMHC changes, and strategies, whether it's for new construction, repositioning, or longer-term return optimization. Now, to put things into context, we're all here because we either want to solve a housing opportunity, whether it's socially or profitably, and also to do it as quickly as possible. CMHC's mission is to help Canadians access affordable, stable, and sustainable housing. One of the primary roles is providing mortgage insurance. This insurance protects lenders against defaults, encouraging development of rental housing, thereby promoting investment into the rental market. CMHC also focuses on the affordable space, vulnerable populations, and sustainable initiatives, to name a few other initiatives. Some of these activities are directly granted or funded by CMHC, or some through mortgage insurance programs, such as the MLI Select Mortgage Insurance Program we will cover today. Peak Hill today is one of the largest multifamily insured lenders in Canada and will close over 700 CMHC loans this year, about $6.5 billion. Loans from $1 million to as high as our largest being around $300 million. About 70% of our loans today are in the MLI Select space, which we will talk about today. On the call today, we have Jen Harrop and Cam Dowell. Jen has over 20 years of experience in CMHC and conventional underwriting, credit, managing teams, fund management, and CMHC securitization. She leads Peak Hill CMHC compliance team, fund management, and securitization of Canada mortgage bonds. Cam Dowell is our lead on CMHC as a senior associate as part of our credit team, liaison with CMHC, and origination CMHC program lead for the past 4 years. We're going to cover today CMHC updates for construction and term, how to optimize the underwriting process with CMHC, and strategies of short-term and long-term financing of insured and conventional loans. We do have a chat feature that you can put questions in that we will take at the end of the presentation. And now I will hand it off to Cam.
Sure. So thanks, Harley, and thank you everyone for joining today. So as Harley mentioned, I've been here at Peak Hill for about 4 years now. I oversee the CMHC program. I noticed that I actually wasn't on the initial banner for the webinar today, so you could also call me a special guest. But basically, my objective today is to go over the 2 standard CMHC programs that we see the most of. And then I'll basically go over some of the CMHC changes that we've seen and provide some recent updates that we have and the outlook we see moving forward. So the standard program, the CMHC, is basically your standard base level kind of insurance. So this is for obviously refinancing of multifamily assets. This ranges between retirement homes, social housing, student rentals as well. But this program allows for a maximum leverage of 85% loan to value. It ranges between 1.2 and 1.3 debt service coverage ratios and allows up to 40-year amortization. The MLI Select program is a very popular program that came about in 2022. So this product is basically 70% of our new portfolio or new applications that we've seen today. The purpose of this program is to basically promote affordable, accessible, and climate-friendly housing within Canada. So this includes higher loan to value ratios, lower debt service coverage ratios, as you can see here at the 1.1 to 1.4 range, and then up to amortizations of 50 years. With MLI Select, you have to basically get a point system. So these point system is a certain amount of points that are committed to social and environmental outcomes that allow for better incentives. So at the end of the day, the more points you get, the better program you get. Higher leverage, lower debt service, longer amortization. So not to get too deep into the point system, I'll give you a rough idea of what it actually looks like. So specific to the affordability component, for existing properties today, you can earn about 50 points for 40% of the units affordable. You can earn 70 points for 60% of the units affordable, and you can earn up to 100 points for 80% of the units affordable. Given there's a lot of variations to the type of asset you have, it depends on that. So you can compare this to new construction. 50 points would give you 10% of the units would give you 50 points. 15% of the units being affordable will give you 70 points. And then 25% of the units will give you 100 points. So there's multiple different variations. You can mix them together, but basically at the end of the day, you want to achieve the most amount of points to incentivize better, favorable parameters for your asset. So I guess the last key benefit with the MLI Select program would be the cost benefit as well. So through CMHC, you have both, you have insurance premiums here. So the standard program, as you can see here, there's basically about 200 swing between the max leverage up to including EGI Med through the standard rental housing program, and through the MLI Select program, you're seeing around 2.8%. So ultimately, at the end of the day, I want to get at is that the MLI Select program is a cheaper cost of funds. It pushes social and environmental outcomes, and it rewards you with better incentives for your housing loan. I would like to highlight actually one thing with the affordability component of MLI Select. It is our understanding that there will be a new update to market rents for affordable units. CMHC is waiting on Stats Canada for some sort of data. We expect to hear some sort of update in the coming months.
The last data was from 2016.
Yeah, so there's updates to happen for sure. So we'll move to the next slide. So here I'll provide some key changes from CMHC. The 5 key topics you've seen through advice through advice 253. I'm sure some of you are more aware about it as it's been released, but for some of you that don't know, I'll briefly go through them. So CMHC is changing the classification of projects. So previously you did not need to demolish existing residential buildings for new construction. This has now changed. You will be required to demolish existing residential buildings prior to submitting any applications. This is actually not the case if the residential building was vacant for 12 months. With respect to commercial buildings, that demolition is not exactly necessary. The commercial structure can be converted to residential without being demolished. This would be considered as new construction. The MLI Select scoring criteria has also changed as of June 19, 2024. So as I mentioned before on the affordability point system there, we have the same type of scoring for the energy efficiency as well. So this is reduced to roughly 35 points, or for 20 points for level 1, 35 points for level 2, and now 50 points for level 3. Historically, we've seen quite a bit of MLI Select loans have the energy efficiency component, much like the 100 points for 80% affordable units, or the 100 points for 25% of new construction affordable units. We saw that for the 100 points for the energy efficiency. So although this is good, my presumption is that CMHC wanted to look for more balance within those 3 types of incentives, that being energy efficiency, affordable, or accessible. With that change, I expect to see some more. I expect to see more affordability components in order to max out the MLI Select incentive programs as well. The third item I would say is the maximum amortization period for new construction project is being extended from 40 years to 50 years for the standard. Environmental site contamination, CMHC will accept applications with contaminated sites with remediation within 6 months. And then the final update I would want to note is that CMHC is no longer allowing correspondents to submit multi-unit applications directly to CMHC. Only approved lenders will do so moving forward. So this is effective as of yesterday. Given our close relationship with our brokers, we're expecting this to be a very smooth transition, no delays whatsoever. I believe that at the end of the day, it brings the importance of that broker-lender relationship. the end of the day, as you will be starting from the get-go with that broker and borrow and approved lender. You might ask why CMHC has made these types of changes. You know, we believe that there's a standardization across the industry that needs to be held. There's more accountability that are going to be on the approved lenders, such as PKO Capital. Given the increase in volume, I believe this will lead to quicker turnaround times for our borrowers. So I believe it is a positive. So in closing, I'd like to know that CMHC does come up with updates, you know, all the time. PKO want to be a valuable resource for you all. So ultimately, feel free to call us at any time. You know, I work all the time, so happy to pick up the call whenever you need. So, Jen, you want to go next?
Thank you, Cam. Yeah, Cam's the guy who doesn't sleep, so go ahead and call him whenever.
Yeah.
But, I'm gonna take it from the theoretical that Cam's kind of covered. I'm gonna talk a little bit about what it looks like once the application comes into PKL as an approved lender. So we're gonna break it into two parts. We're gonna talk about the work that PKL does before it gets to CMHC and some of the reasons that we do that, a little more upfront work to make sure that the second part of the process is as smooth as possible. Excuse me. So we're gonna start right at the beginning with the documentation. First part of the application process, we're gonna send you a great big list of documents that are required. It is a lot, but we're here to work through it with you. There's a lot of mandatory documentation and there is some optional, and we're gonna go through the differences there. So absolutely mandatory is full financial disclosure. We're gonna look for corporate financial statements, we're gonna look for personal net worth statements with backup documentation. We're gonna look at your credit scores and your credit reports. We might ask some questions there. There's no judgment being passed. It is simply getting ahead of any questions that we might be asked in the future. We're gonna look at your tax returns, and that's gonna give us a really great fulsome idea of your financial situation and your ability to service debt. And real estate is such a relationship business. That's why we keep working with our borrowers over and over and over again, because we get this part really dialed and it makes the rest of the process go pretty smoothly. So the third party reporting that we're gonna be looking for, if you've got a property that's less than 25 units, you must have an appraisal. Some of our clients find it useful to have an appraisal even if it's not mandatory. So this is one of those optional ones, but it can be helpful in terms of making sure that we get a really accurate valuation and we have it really well supported. We can go back, we'll talk a little bit more about how we support values without an appraisal in a couple of slides, but you know, an option there. For properties over 7 units, we must have environmental reporting. We need a clean phase 1 that says no further investigations required. If we need further investigation, we sort of approach that as it comes. As Cam mentioned, there is a bit of a carve out for construction projects that have a little bit of contamination, but that would be something where I would really encourage you to pick up the phone and call your contact at PKL to walk you through how that might work. Building condition assessment is going to be largely optional, can be incredibly useful. Can be very useful to get through an application faster. It gives some confidence on the state of the building, the marketability, you know, are you gonna need to do a lot of repairs and maintenance, or are you in pretty good shape? This is also where you're gonna provide your CapEx history. Brag about it, tell us how much you're spending on your buildings. Did you replace the balconies? Are you turning units and freshening them up on lease expiry? That's where we're gonna find out about that bit. And then any MLI Select specific documentation. Again, that at application time, anyone from PKL will be happy to walk you through exactly what you'll need there. Now that we have all of that, we're gonna go right into operating history. We're gonna collect 3 years of operating history if you've owned the building for that long. On a purchase, of course, we're gonna have to work with what you can get, but we are looking for that operating history so that we can provide context. So even if it's a little rocky, if you were renovating, or if you had really high utilities one year, but you put in a bunch of things to make it more energy efficient, that's okay. We can explain all of that. Any operating history that we have is gonna provide context for our underwritten expenses. And you know, we're also gonna collect last year's or this year's tax and insurance bills, you know, to the extent that we can get the 2024s. At this point, that's really encouraged. If we have 2023s, we're gonna underwrite to a bit of an inflation so that we make sure when we pull the tax certificate right before closing, we don't end up with any surprises that interrupt our cash flow. Utilities, we're gonna collect those last 12-month bills, we'll add all that up for you and come up with our underwritten number. Our rent roll is gonna be incredibly detailed, so we're not just gonna go unit type and rent, we're gonna include your rent, your unit size, we're gonna look at your rent per square foot, what utilities are included, if there are any appliances included. This is also where we're gonna disclose anything that's a little bit out of the ordinary, like a non-compliant unit, head leases or bulk leases, any other charges that you currently have that we need to be working into our cash flow underwriting. The last piece of our assessment before we get into the property is gonna be on our sponsorship. And we're gonna look at all that full financial disclosure, and we're gonna do a full portfolio analysis on your existing real estate portfolio. So if you just go to the next slide, please. It's gonna show you a little bit of what that looks like. So we're gonna do a full analysis on all of your properties. You're gonna give us your income and expenses. We're going to look for values and cash flow on all of those assets. So we might ask you for mortgage statements. If you have an appraisal around, that's great. If not, we have an enormous amount of data that we can access to help value those assets. And this is also where we're gonna really dial in on organizational structure. So it is incredibly important that we get that right from the outset. A lot of our clients actually go to their lawyers before they send to us. The reason for that is that org chart is gonna end up forming a part of your certificate of insurance. We're obligated to make sure that's accurate on closing. If there's a little change on closing, maybe an intermediary company wasn't noted, we do have to go back. We may incur a post-decision fee. It may also delay closing. In a worst case scenario where it's quite inaccurate, we may have to start the process again. The beneficial ownership isn't represented accurately. So we really do hone in on that as early as we can in the process to make the rest of it as smooth as possible. We can just go to the next, please. Thank you. So now we have a really great understanding. We have a great relationship in place. We've done a few deals. We don't need to do any more on the borrower assessment. We're gonna look at your property, or we're gonna look at the cash flow that it generates. So that's where that rent roll comes in. That's gonna take care of our rental income. Any vacant units, we're gonna mark to market. We're gonna put in a market laundry map, or maybe we're gonna look at your historicals, depending on what that looks like. A lot of our clients are very creative in how they operate their buildings. They've got cable revenue, storage, satellite, anything like that. We're gonna have that in our ancillary income. Commercial revenue, I'm just gonna touch on very briefly because it's a very case by case. And we're gonna have that in there if appropriate. All of that is going to roll up into our gross potential income. We're gonna apply a vacancy rate. Again, looking back at your historicals, how have you operated historically? Have you performed a little better than the market? We're gonna look at the market rates. We're gonna look at your rent versus the market. And we're gonna make sure that we have a really accurate vacancy rate in there to get to our effective gross income. Excuse me. So we've taken care of the income side. Now we're gonna look at the expenses. The expenses in a CMHC underwriting are quite prescriptive. So we're gonna look at property taxes, insurance, and utilities. That's all gonna be based on prior. Where we get into a little more variability, depending on either both what the construction of your building is it low-rise wood frame, high-rise wood frame, or concrete frame? And that's gonna impact your management fees between 4.25% and 5% of EGI. Your R&M, if you're a low-rise wood frame in Ontario, you might be down by that 610. If you're high-rise concrete in BC, it's gonna cost you a little more to operate. It's gonna be about 975. Salaries, same thing, depending on where you are in the country, what kind of asset you have, 420 to 700 per unit per year. The replacement reserve, we're gonna go all the way back to that really detailed rent roll. Take a look at what appliances are included. We're gonna take a look if you have any heat pumps or elevators, and we're gonna apply an appropriate reserve accordingly. That's just gonna let us make sure that you have the cash flow to support the debt, even when some of these things need to be replaced. The other cost is kind of a catch-all. It's gonna cover your administrative, it's gonna cover your marketing, your snow removal, things like that. That's gonna be included in other. Again, depending on your location, depending on your asset type, it might be 0% because you're all the way at the top end of that R&M. It might be 2%. It's gonna be between 1 and 2 most of the time. And that's how we're gonna get to our net operating income. I do see a bunch of questions coming in, and I promise I'm not ignoring you. I think we're gonna push most of them to the end, but we'll be happy to take a look at some of those as we're able. back to the net operating income, that is gonna drive two big things. It's gonna drive our value, it's gonna drive our debt service coverage ratio. Those are the constraints to your max loan amount. So our debt service coverage ratio, net operating income divided by our annual mortgage payment. Depending on your program, it's gonna be between 1.1 and 1.5 times your net operating income. That low end of the market or low end of the scale is gonna be your MLI Select, your small purchases. The higher end might be something that operates more like an operating business, like a retirement facility. Generally speaking, for bread and butter standard, you're gonna be between 120 and 130 for a 10 or 5-year loan, respectively. The last thing we're gonna do with your NOI is we're gonna take that and we're gonna create a value for your building. So if we can go to the next, please, we're gonna talk about how we value assets. So like we said earlier, we may have an appraisal. If you're 5 to 24 units, we will absolutely have an appraisal. If it's larger, it can help speed things along to have an appraisal. But Peak Hill closed $3.5 billion in mortgage transactions last year. We're $3 billion year to date. We have an incredible database to draw from, where we are looking at recent cap rates. They are comparable to your asset in quality, in location, in clientele, and that's gonna give us the opportunity to have the best possible representation of your building and its value in the market. That value, we're gonna take the cap rate, NOI divided by cap rate is gonna get us our value, and then we're gonna get to a max loan amount based on the DSCR and loan to value constraints. Now that we've done all of that assessment, all of that analysis, Peak Hill's gonna put together a package. It's gonna be probably 12 to 15 pages roughly of analysis. And I've just snapshotted a little bit of what that might look like. So on the left, you've got some basic parameters. You can see this is a 100-unit building, so we don't have an appraisal value, but we've done our own underwriting. We've come up with a value. And on the right is just a bit of a snapshot. Now I've blurred it out because it was an actual file, but gives you an idea of what all of those things that I just talked about, how that looks at the end of the day. We're gonna provide all of that data to CMHC, and now we're gonna move to the CMHC part of the process. All that work that we did up front, we are looking to speed up the parts that we can of the process. So stage 1 with CMHC, we're gonna be an intake. An intake coordinator is gonna pick up our file. The first thing they're gonna look at is say, do we have all of the appropriate documentation? Yes, great. Move to the next stage, and they're gonna upload it to their underwriting system. We are going to make sure that everything is accurate, complete, it's gonna upload perfectly. We're gonna move right on to invoice. Anytime something like that comes through in great condition, it moves it through the process faster. At that point, your loan's we're gonna have an invoice issued, we're gonna add it to the underwriting queue and move to stage 2, which is the review of the lender underwriting. So CMHC underwriter is gonna pick up the file and they're gonna review what we've submitted. Ideally, they're coming back with maybe 1-2 questions. If there's a challenge to be made on some of our assumptions, that's where that would happen. All of that work we're doing up front is gonna allow us to shorten this part of the process as much as possible. To get to that point where they're offering a preliminary loan amount, we're gonna come back to you with, we have an offer for this loan amount at this max rate. Does that work for you? Great. Once we accept and say, yes, we are prepared to accept that, provided that it's approved, it goes into CMHC's approval process. 90% of the time, that's gonna be 1 to 3 days, often overnight. If you have a more complex deal, construction, large loan requiring higher approval limits, it could take a little longer, but that Peak Hill relationship with the CMHC underwriter, we're gonna be talking a lot and letting you know where you are in the process. So I'm gonna pass it over to Harley now to talk about when it might make sense to do a bridge versus when you're gonna apply for your full CMHC.
Since we've had a lot of questions coming, we've got about 15 questions. There's a couple here that I can ask you, Jen, that you covered, but just a little bit further on the third-party reporting. There's a question here, if CMHC has a required list of appraisers or third party.
Peak Hill has an approved list of appraisers. For the most part, an AACI appraiser that is experienced in underwriting multi-unit assets is likely to be acceptable. Just give us a call before you engage that appraiser.
Okay, other question was on personal and corporate tax returns. If you can clarify when there's a personal guarantor or a corporate guarantor.
Yes, absolutely. Thank you. A corporate guarantor, we don't need your tax returns, we're gonna look for your financial statements. Personal guarantor, we will look for those T1 generals and the full T1.
Okay, and that's for disclosure purposes, not necessarily an underwriting income base.
Correct.
Mostly disclosure, okay.
Yeah.
Okay, great. So now we're gonna continue to look at these questions. We're just noting them down and we'll tackle them as we can, or we'll get them all at the end. And so you can see on the screen here, we have a few comments on the benefits of bridge financing and the best time to apply to CMHC. So, you know, the benefits of bridge financing, obviously, we all know that the process that you just saw from the underwriting perspective and the submission process does take time with CMHC loans. And so, you know, we are quite successful for our clients in doing bridge loans on acquisitions. We could do a bridge loan for a month, for 3 months, for 6 months, a year, depends on what the client is looking for and how they're trying to optimize the property, whether they want to go over to CMHC immediately or whether they want to wait it out a little bit for various reasons, which I'll touch upon. Bridge loans, obviously, they can be interest only, so that helps on the cash flow side, even though bridge loans are more expensive. Bridge loans today could be a prime +1 to prime +3, depending on the loan to value, 70, 75, 80, 85% typically is what we're looking at on the bridge loan side. To close bridge loans, it could be as quickly as a couple of weeks that we've done before, and maybe as long as a few weeks, but obviously a much quicker process. With a bridge loan as well, you can have additional financing. So if there's a property that one is doing renovations in the interim after acquisition, there's an ability to do future fundings as well on a cost to complete basis. That as well, we've done a lot of those loans for clients. Now, some clients also want to do bridge loans because they want to hold a property. Maybe they want to sell a property, have a little bit more flexibility, not lock into a long-term financing, hold for maybe they expect interest rates to fall. The Bank of Canada cut rates by 25 basis points today. So I don't know what it did to long-term rates today, but they may anticipate rates come down. So they may want to hold on a little bit in terms of applying to CMHC a little later in time. Obviously, we're quite experienced on the CMHC takeouts, how to underwrite them and what the loan proceeds would look like. So we can obviously go through with clients what that looks like as in a property if it's improving and so forth. If someone's projecting rents 6 months, 12 months, 18 months out, we can give some advice in terms of, is it better to apply to CMHC now, or is it better to apply in 6 months or 12 months or 18 months, depending on the location, where it is in the country, depending on the quality of the property, depending on the turnover. Are you turning 10% of the units per year, 20% of the units per year? We could take a look at that and sensitize. Is it, give you some options? Do you want to do a bridge loan? Do you want to do even a term loan? So we can do term loans as well. Term loans could be, 5.5%, 6%. But you're locked in for a year or two on a term loan conventional basis. So one could look at that option. One could look at a more expensive variable option that gives full flexibility, can apply to CMHC at any time, or one can go straight to CMHC. Typically, when one is going straight to CMHC, it's when a property is fully stabilized, you've reached your sort of maximum rents that you anticipate, fully operational stabilized property. Typically looking to lock in a long-term loan, a 5-year, a 10-year loan, and so forth. That might be best in a rising interest rate environment. You might want to lock in early, you might want to lock in longer term and so forth. Obviously, bridge loans are more expensive today than they were several years ago, given what prime rates are and so forth. In terms of, we'll talk about construction. We can go to the next slide, and that's obviously some examples there. But I'll talk about conventional construction. And ensure these are just represented some deals that we recently did in the construction, stabilized space and then bridge space. But conventional construction might be better in a market with further rental growth for better long-term equity takeout at completion. There was a question we had about this. When's a better time to do conventional over CMHC construction loan? So we've seen the strategy work in markets like Halifax, Montreal, and Vancouver, to name a few. So really, you're looking at markets where you think rents are going to be higher in 2 years from now or 3 years from now, substantially higher, because when CMHC is underwriting a deal, CMHC is looking at today's rents. They're not looking at trended rents in the future. So if you expect that there's going to be tremendous rental growth in a market, you could look at doing a conventional loan and then doing a CMHC loan at takeout. So when one is doing a CMHC construction loan, you're paying for the premiums for 50 years on new construction, and CMHC uses current rents and not future trended rents. Given the cost of the premiums, you wouldn't want to do a construction loan. You wouldn't want to do a CMHC construction loan and then apply for another CMHC construction loan at completion. You're going to be paying those premiums twice. Obviously, it doesn't make sense to do that. That can be cost prohibitive, right? So in that case, you might want to consider a conventional loan. Now, given the cost, of a conventional loan, the conventional loan cost maybe, cost about, with all the fees and everything, 1 to 1.5% more than a CMHC insured loan. So you have to kind of look at the pros and cons of your deal, your capital structure, and so forth. Conventional, you're typically, you're at 75, 80%, maybe 85% loan to cost. Whereas in the MLI, you can go as high as 95% loan to cost, right? So you have to look at your capital requirements and what makes sense for you and so forth. If one is doing a CMHC construction loan, you can do a second down the road after completion, sort of a year after completion. You could look at doing a supplementary second. That can work at times. So we've done some of those at times as well. The advantage of the CMHC construction loan is you're guaranteed that long-term loan. You can better sleep at night in case rates change rapidly, or occupancy takes a lot longer to lease up the property. Given that you don't have to have an EGI requirement with CMHC, if it takes you longer, you're not worried about that takeout loan. You've got that loan and you've got that certificate. The certificate is good for the amortization. A lot of people sometimes don't realize that if you have a 5-year term or a 10-year term or a construction loan, you got a 40-year amortization, 45 or 50-year, it's actually good for that 50-year period or 45 or 40 years. So that certificate is gold for that period of time, that no matter where your future occupancy is or performance of the property, there likely will always be a lender to do that loan, even if the debt service may not be there in the future. It's a commitment for 50 years, essentially. So there's quite a value that you're paying for to have that certificate. So if you're a conservative borrower, conservative developer, doing a CMHC loan would be your natural place to always be active in. Now, for the most part, about 80–90% of our loans today are CMHC insured today, but there are cases that one does want to look at conventional. It depends on your timing, depends on your risk tolerance, and depends on your capital plan. And we can help you look at those scenarios to help you decide what's best. We've had some situations in a timely manner that we've started out as a conventional construction loan, and then we've moved it over to a CMHC construction loan. So that's another possibility that one could do if one starts out conventionally. Now, let's take a look at the questions over there. If you can pass me the sheet, try to get to as many questions as we can. Okay, Jen, how long does underwriting an application take?
Underwriting an application, that timeframe can depend quite a bit on how much information we have up front. Provided that we get everything up front, you're looking at likely 2 weeks-ish from initial application to us to getting it into CMHC. Okay.
And what are the cap rates that CMHC using on new rental in Toronto? So in deals that we've submitted, we've seen around a 4 on new construction in Toronto. So I can answer that one. Cam, what are wait times like at CMHC today?
So I would say, assuming the loan or the application is complete with all docs, as Jen mentioned, you're probably looking around 10 weeks before an underwriter picks it up. So they might actually get the application into the queue, but before an underwriter actually starts underwriting the loan, you're looking at about 10 weeks, 10 to 12 weeks.
How many units minimum to be eligible for CMHC MLI Select?
It's 5 units.
5 units. Okay. Main difference is when you assess ground up residential development versus office to residential conversion. Great question. So we've started to do some office to residential conversion recently. You'd have to contact me specifically that I can help you through that. I wouldn't say there's necessarily any particular difference.
Yeah, I mean, I think the only thing that I would say that's true of any change of use is there can be some nuance in terms of fire code. And you just want to make sure that whoever you're working with is aware and able to make sure those are tied off early on in the process. It helps you get a more accurate budget.
So the one thing too that is there is not a requirement when we submit a deal to CMHC to have a cost consultant or a QS report in hand. Now, we highly advise it. And the reason for that is when you go in with your budget to CMHC with your hard costs, your soft costs, your contingencies and so forth, you're basically set, right? You can't make any changes. It's a lot harder to and so forth. And so making sure that you have a QS and a cost consultant that you're confident with, that's reviewed everything, that also makes us confident that everything is well organized and so forth. is definitely a big benefit. And so obviously an office conversion requires a lot more skill and understanding of things, and working with an existing building, sometimes things can cost more, take longer than new construction. And so having a QS that's experienced in conversion, I think is important, that's done it before. So I would say that as a point, and having that up front is definitely helpful from our approval process. Regardless of the CMHC process, we still have our approval process that we deal with, in our credit here that we deal with. So that is helpful.
I would note as well, you're limited on cost with CMHC construction. So the exit value for that asset, when you're changing from office to multifamily, you're looking to take out a significant more value. So there's obviously different programs not specific to construction, but that'll allow you to basically use that end value rather than, or get a loan based off that end value rather than come in at the total construction cost.
Does CMHC do non-recourse loans?
CMHC will define those as recourse to the property only. So yes, there will be carve outs for the property owner. There will be carve out liability for environmental concerns and any kind of fraud. So effectively, yes, non-recourse, as long as everybody is behaving the way they should.
65%, right?
Max 65%.
Max 65% loan
That's
value.
correct. There is some more flexibility under the MLI Select. They can consider higher loan to value with recourse to the property only. That is very much on a case by case basis.
Okay, someone asked us if we do conventional construction debt. Yes, we do. So I did mention that pricing could be, around prime plus 1.5, plus or minus a little bit, depending on who it is. And then cost on CMHC insured could be prime minus 25 to prime minus 40, depending on the size of the loan and where it is, and the borrower and so forth. Now, in terms of rate locking, we asked what's the earliest someone can rate lock. So we've had rate locks, 6 months out, 3 months out, 4 months out. We can look at doing longer than that. There's a cost to rate lock in advance. It's usually a few basis points a month, depends on the markets. But we could provide you that quote if you want to rate lock early. There was a question on environmental impact sites. I don't know what the particular question was, but I think it was if a site is impacted but can't be fully cleaned up or monitored, maybe there's an SLRA, screening level risk assessment done. And yes, those can be done.
Yes, that would have to be done in advance of the application. You would want to have that screening level risk assessment. And what that screening level risk assessment does is, from a legal perspective, it is as though the property is clean, provided that you are taking all of the mitigating action required.
Okay. When could do an conventional loan, can you get as high as loan to cost as CMHC? I mentioned typically, conventional will go up to as high as 85% loan to cost. So CMHC, you can go 85 to 95, depending on which program. As well.
So I can speak to, there's a question, can you speak to acquisitions of brand new multi-unit properties under MLI Select, any restrictions, rental achievement requirements? So rental achievement, we will ask CMHC on new construction to provide on an EGI not met basis. And what that means is your premium's a little bit higher, you don't have to be fully leased at funding. We have found on new construction, CMHC has been pretty receptive to that. Provided that we're comfortable with the rents, that they're in market, and then it's going to be able to be absorbed in a reasonable amount of time. As Cameron said, we do have our own credit process as well, and that's where we actually look to back to that assessment of the borrower as a whole. Are you going to be able to sustain those payments for 3 or 4 months while you lease up? So, I hate to be the person that always says it depends, but I would say under MLI Select, we're often successful in an EGI not met funding.
Question, what happens if CMHC approves a loan from another lender and we want to move it over to PKIL? Yes, you can transfer the certificate. You have to talk to the lender that submitted the application for you. Just writing us a few more questions there. That last question, does someone want to address?
Construction. So there's a question for construction of 25 plus units, the appraisal rents are not relied upon, it's more of a CMHC internal market rent. I'm not sure I agree with that. An appraisal, especially on a new construction, can really prove out if you have a property that's not going to be sort of an average product. You have something that's gonna be a higher end product or just something a little bit out of the ordinary. Appraisal data does tend to be very helpful in proving out the market's willingness to support that rent. Peak Hill again has its own databases that it uses as well to support that, but that is an area where coming in with the best possible application, the strongest argument for the projected rents is gonna make a difference in your application.
There was a question, what does EGI mean?
What does EGI met or not met mean? I do apologize, I should have said that at the outset. So an EGI met would mean that the property is full and the rent roll is effectively stabilized. Might have a couple of vacancies, but nothing material. EGI not met would be in a case where your building was vacant for one reason or another on purchase, or a new construction deal where when the building is built, you're not necessarily gonna have full occupancy on day one. So that's where your effective gross income minimum is not met.
Minimum size for construction and purchase, I mean, we've done loans, we've done construction of 2 million, we've done $2 million construction loans. We've done loans as low as $700,000-800,000, depends who, what and where, but that would be the lowest that we would do. Okay, any more questions? We will make this available to people afterwards, and then if people would like the presentation, just email one of us and we'll make that available to you. And then obviously you can contact us any more specific questions. I'll take another minute if there's any more questions. Okay, great. We hope we added value to further understanding of CMHC and conventional lending. I encourage you to reach out to your relationship manager, dig further into more specifics as needed. Once again, the fact that you listened and took the time to better understand CMHC and multifamily financing, you get a passing grade on your first top quiz. Thanks all for attending, and we'll speak to you soon.
Thank you.
Thanks, guys.